We just finished recording a great episode with Thomas Castelli, who works with Hall CPA, tax advisors, tax strategists, CPAs. They're there to help you get your tax, finances, everything in order. And especially in this conversation, Thomas provided a lot of great information on what people can do to be proactive with their taxes and their finances to make sure that they've got everything in order to get the most money back. And most importantly, not pay much money to the government because no one wants to lose that money in taxes. Patrick, what do you think about today's episode?
As always, James, I thought today's episode was packed full of hard-hitting, insightful information, man. Like, taxes is so important. It eats up 25 to 40+% of our income that we're trying to bring in to be financially independent. So if you want to pay the government less money, make sure you listen to the end. And here it is. How's it going, everybody? And welcome back to the Real FI podcast. I'm your host, Patrick McGrath, with my co-host, James Rippion. How's it going today, James?
Going well, Patrick. Thank you for that intro. And I'm excited about today's podcast. We've got a great guest with us here, Thomas Castelli. Thomas is going to give us a little bit of background on what he's got going on, his investments, and how he is working towards financial freedom. So without further ado, Thomas, why don't you introduce yourself and tell our listeners a little bit about what you got going on?
Yeah, absolutely. So my name is Thomas Castelli. I'm a CPA by trade. So I help people, real estate investors specifically, reduce taxes, which is a big part of the journey towards financial freedom. As we all know, taxes could be easily one of your top expenses. But if you're investing in real estate, it's a great opportunity it's a great asset class for generating tax-free income. So that's what I do full time. Now, on the side, I am investing in real estate primarily through limited partnership interest at the moment. Allows me to stay focused on the main thing for the time being until I can accumulate enough passive income that I have financial freedom. So that's kind of what I'm doing right now. Mainly, I'm investing in a car wash fund, which is very interesting. A lot of cash flow is going to be getting thrown off of there, in an industrial fund, in a multifamily fund. And all of these give distributions on a quarterly basis. And at some point, I'll have enough distributions where I'll be financially free.
Cool, sweet. So, let's talk about those passive funds, in the second half of our conversation. Right now, let's focus on your work as a CPA. Tell us how you got into that position, like the kind of things that you're doing and what you're doing for your clients. And then we'll just kind of steer the conversation in that direction generally.
Yeah, absolutely. So I went to college to become an accountant. And while I was kind of in college, I started reading the Rich Dad Poor Dad books, The Richest Man in Babylon, a bunch of kind of self-help / finance books. And there's a kind of a recurring theme within that. It was real estate. A lot of wealthy people got there through real estate or pour a lot of their money into real estate. So I kind of fell into that hole. I started going to various real estate events, kind of trying to educate myself as much as I could on the topic. And I kind of realized that the 9-to-5 grind wasn't going to get me to where I want to go in life. So I went to like a 3-day weekend where they started breaking down all types of real estate strategies, syndication. Real estate syndication was really the primary focus. And I really fell in love with that. And then when I graduated college, I started working for a large accounting firm. It was a BDO, a top 5 firm. And then I was doing audits on these big companies. I was like, I'm not really this big stuffy corporate guy. I'm more of a small business / real estate guy. So I eventually met the founder of Hall CPA and joined the firm. And through that, I was able to kind of marry my tax background with my passion for real estate. And now, basically I help real estate investors reduce taxes through proactive tax strategy and planning. So kind of one of the, really interesting things a lot of firms do is they'll just prepare your tax return at the end of the year. Or at the following the end of the year, right? And the problem with that is your tax return is just a report card of what happened the prior year. And once that year kind of closes out, there's very few things you can actually do to change your tax situation at that point. So what we do is a little bit different. Is we look at someone's tax situation, say, here's where you are today, here's where you're looking to go in the future, here's the different strategies that you can use to minimize taxes as you go along your journey, so that when it comes time to file your tax return, whether it be next year's tax return or a future year's tax return, you're putting yourself in the best position to minimize your taxes and you're not missing out on significant opportunities for taxes. So that's what we do at the firm. That's what I'm currently involved in, and we do that through all different types of strategies. So happy to dive into some of those if you'd like.
Yeah, 100%. You know, what's really interesting is that I was actually referred to Hall CPA last year by my local CPA firm, who had said that we had kind of like outgrown them and what they were capable of being able to do, providing us with the best service. And they recommended me to Hall CPA. And I currently am using you guys as our tax strategist and doing our taxes. So it's kind of interesting to hear now, like full circle, to be on a call with you guys talking about all of this. So I am a client of Hall CPA, just full transparency. And, you know, it's been an absolute amazing so far. I really do love like the quarterly meetings that, you know, take place and all of that. I mean, look, having the right tax strategist is extremely important. And I'm going to press that over and over again, because as soon as I signed on and they went and looked back at my previous year's taxes and the current tax filing, we got a $23,000 check back from things that were missed, that weren't done by our local CPA that I met at a real estate meetup, you know, and thinking like, hey, dude, they do real estate. This is what they're involved in. This should be perfect. And as you grow your business, you have to, you know, proactively grow your tax strategies and your retirement strategies. And sometimes you outgrow the small or local firm that you're with, and you need to go to that next level. And that's what we did. And that's why I'm really excited to be talking to you today about some of these strategies that we can help other investors out there with a couple properties or a long-term or a short-term investment strategy on some of the things that they can do now, you know, where we have 5 months left in the year. So they're not trying to unbake the cake, which we all know you can't do. So just full
Right.
transparency there.
Yeah, that's really interesting. It's a small world, and glad they referred you over to us, because that's awesome that you were able to get a $23,000 tax savings. You know, it's really interesting. I'm not trying to knock any CPAs or tax professionals out there, but when you're dealing with real estate, it's a heavily nuanced section of the tax code. And what happens is you have a lot of CPAs out there and other tax professionals that are generalists. So they'll work with a lot of different clients across a wide array of different industries. And the problem with that is the consequence of that is sometimes they never get into the nuances, and because of that they miss things that a specialist, who's someone who specializes in real estate, would otherwise be able to catch. So just really interesting how that all kind of came full circle.
Exactly. Mm. So with that, let's kind of dive into some of the most common mistakes or things that you see on tax returns when someone makes the leap to a specialist company like your guys' self, that, you know, if people could take the steps now, they could avoid some of these common mistakes with, you know, how they're set up, how they're doing renovations or whatnot. Like, what are some of those common things that people are making mistakes on?
Yeah. So I think the first and the biggest one, probably for the majority of real estate investors out there, is not understanding how passive activity losses work, and then actually carrying them forward. And I'll kind of break that down a little bit. So rental real estate in general is passive by default. And what that means is that the losses that your property generates, right? So when you have a rental property, you're gonna have rental income, then you're gonna have expenses. You're gonna have like utilities, repairs and maintenance, insurance, property taxes, all of that stuff that you actually have to pay out to a third party. But then you have this expense called depreciation. Now, depreciation is a non-cash expense, which means that it lowers your taxable income, often creating a loss, despite the fact that you might have generated positive cash flow. And let me just give you a quick example of how this can kind of work, right? So let's just say you had $10,000 of rental income on property A, and you had $5,000 of real expenses. And what I mean is like all the property management fees, all that type of stuff. that would leave you with about $5,000 in quote unquote like net income or cash flow. Now, in most businesses, you would end up paying taxes on that net income or that cash flow. However, now you have depreciation. And because real estate is such a expensive asset, your depreciation expense could be quite high, and that could create a loss. So let's just say you had a $6,000 depreciation expense in this example. Well, now you'd have $1,000 loss for tax purposes. So this means a few things. It means A, you generated $5,000 into cash flow tax free, right? Because you had the $10,000 of rental income, $5,000 expenses, but now you have this $6,000 depreciation expense, which is only on paper. So you put $5,000 into your pocket tax free. So that's awesome. Now the question is, what happens to this loss, this $1,000 loss? Well, for most real estate investors, this loss is going to be passive, and that means it's not going to be able to offset income from non-passive income, it's called, such as income from a job, an active trader business, and believe it or not, gains from stocks, bonds, dividends, interest, all that's also considered non-passive. So that $1,000 loss is typically not going to be able to offset those other forms of income. Instead, it's carried forward to future years where it can be used to offset future passive income, such as income from other rental properties you might own or gains from the sale of your rental property. Now, this is carried forward on Form 8582. It's a very important form for real estate investors on your Form 1040 because it's what actually carries your passive losses forward. One of the biggest things we see on some other people's tax returns is that their CPA or their prior tax preparer was not carrying this form forward. And when this form is not being filed every year, you are potentially risking losing all of your passive losses. And while, yes, maybe you can't use them today, there will likely be a time when you're going to have positive rental income or you're going to sell property and have a capital gain, and those losses could be used to offset that. So that's the number one biggest thing, is that some people just do not file. Some, tax professionals just do not carry the Form 8582 forward.
So speaking about that, let's just say you got a new client that comes on board, similar to Patrick's situation. How far can you look back to generate those losses to carry forward? If in prior years we didn't file it appropriately and we have to go amend a prior tax filing, how far back can we go resolve that?
Yeah, so you're typically looking at about 3 years. If it happened more than 3 years ago, there might not be anything that could be done. Which is why it's such a problem, because if we caught it maybe like last year or the year before that, we might be able to go back and amend it, carry it forward, and amend those returns. But if it's 3, 4, 5 years ago, you're running, you might not be able to do that, and you might be SOL, for lack of a better word.
Exactly. And like you said, one of the important things with, I know a lot of our listeners out there are doing value add real estate. They're buying distressed assets or undervalued assets. They're investing money up front to do renovations, to put tenants in there as turnovers happen. So, depending on the size of the property that you're doing, if it's a small multifamily or something like that, it could take a year or two of doing turnovers and investing this money inside of the property where you're showing a loss because you've had, extended vacancies, you've invested a lot of money into the property, and now you're carrying these losses. But, year 3, year 4, you're not doing renovations, you're not having turnovers, you're just going off those regular expenses. And now that's where those carryovers from years 1 and 2, when you were injecting a lot of capital into these properties, that's where it can offset that right down on those other years for that particular property.
Right. And if you're trying to achieve financial freedom, right, like you want to pay as little taxes as possible, right? And rental real estate is one of the asset classes that could do that, because if you ever did a financial, I'm sure you guys have done it, and many people on the show, but if you ever pull up a spreadsheet, run how much income you need to earn to achieve financial freedom, and you run it on a tax basis. So in other words, you're paying taxes versus how much you would need if you didn't have to pay taxes. It's usually a pretty big gap. So, and the way to do that, the way to get to shorten the gap, is by generating as much income you can from tax advantage sources like rental real estate. And that's what makes this Form 8582 and all these passive loss carry forwards all the more important. because you don't want to pay taxes on your rental income. You want to avoid that if you can, and this is the way to do it.
I love that. I love that. All right, so we got that one down. So what is like the second thing that you see when you're reviewing someone's prior year tax returns from, you know, a CPA or a non-specialist? Like what's the next biggest thing that you see that they're not doing?
Yeah. Okay. So the second biggest thing I would say missed expenses, but that's just too that's not big enough, I think, for this. But that is one. But the second biggest thing is erroneously electing or not electing the real estate professional status. So, kind of to long story short, like I was saying before, those rental losses are passive. But if you work more than 750 hours and more than half your total working time in a real property trade or business, including rental real estate, um, then you can use the losses. Then you qualify as a real estate professional, and then that allows you to use the losses from your rental activities to offset other forms of income, such as income from a job, an active trade or business, or like stocks, bonds, and stuff like that. So a lot of CPAs will uh, erroneously elect it. So they'll elect it for clients who have a full-time job. If you have a full-time job, um, you're not going to qualify as a real estate professional status for the real estate professional status, because it requires you spend more than half your total working time in real estate. And the IRS considers a full-time job 2,080 hours. So that's 40 hours a week for 52 weeks a year. And in order to prove that you spent more than half your total working time, you need to spend 2,081 hours in a real property trader business on top of your full-time job, which means you're working 81 hours a week for the entire year, which everybody knows is virtually impossible. And for that reason, a lot of people end up losing in tax court if they make it that far. In those situations. So we see a lot of CPAs just erroneously electing it when it shouldn't be elected. And that might be good temporarily, help you offset taxes. But if you get caught in an audit, you might be subject to back taxes, penalties, and interest. And nobody wants that. So we see that happening a lot. On the flip side of that, we see people who clearly qualify for the real estate professional status not electing that status because their CPA or their tax professional isn't aware of it or doesn't know how it works or whatever the case may be. So not electing it or electing it when it shouldn't be elected is something that we see quite commonly.
Speaking of audits, I'm kind of curious, what you guys are seeing on the front lines. And there's been all this talk in the news about the IRS, like expanding personnel, then other administration gets in, contracting personnel, whatever the case might be there. What is your current, temperature gauge of like audits right now over the past maybe year or two? Are they picking up, just the same? Should people be more concerned and conservative at this point?
Yeah. So that's a great question. I'm gonna break it down like this. So audit rates are extremely low to begin with, like extremely low. It's like less than 1%. So the chances of you actually getting audited in the first place are low. Have they picked up? We've not seen that yet. That's not to say it's not coming. It's just we have not seen that yet. The biggest thing is I can't say that you should be conservative or you should be scared of an audit, but what you want to do is you want to prepare for an audit, right? If you're taking a position that might be scrutinized under audit, you want to make sure you have your T's crossed and your I's dotted for when that time comes, so that like when the audit comes, you're able to easily defend that. And what does that mean? In many cases, that means you want to have good books and records, right? Another mistake that we just see people not doing in general on the investor side for the most part is not having proper bookkeeping, right? Having proper books and records can save you in an audit. You need to have, the IRS requires you to have receipts for expenses over $75. And that's not a guideline, that's a requirement. So if you're ever audited, they could pull your your profit and loss statement and say, well, where's your receipt for all these expenses? If you can't produce those receipts, then you might put yourself in a position where they're going to deny those expenses, and you might be subject to back taxes and penalties. So preparing for an audit is something that you want to do, and that one way to do that is by having a good bookkeeping system. If you are using something like the real estate professional status, which I just had mentioned before, you're going to want to keep a time log of the hours you spend in your your real estate businesses, so that when that audit does come, if they do question, hey, are you really a real estate professional, that you can pull up that time log and say, hey, look, yes, I did spend more than 750 hours, and yes, it's more than half my total working time. And the way you'd prove that is by not having a full-time job, or having time logs for the other activities that you are involved in some cases. So it's not so much that so audit rate, to kind of summarize that, audit, we have not seen audit rates increase. Not to say it's not going to happen, but you don't want to not take the positions or not take the deductions that you're entitled to. You just want to be prepared to substantiate that if and when an audit ever does come your way.
Makes 100% sense. Makes 100% sense. One of the things that I would always do is I bought a calendar book, just a daily calendar book that I would keep in my truck. And at the end of the day, if I worked on any of our properties or doing renovations or painting or anything, I just wrote the unit number and then how long I was there and a brief description, painted upstairs 2 to 5 p.m. or whatever, and just had the unit number there. And I just made sure to do that after every day that I did, because I've qualified for real estate professional status the last 2 years, and will be this year, obviously. And that was one of the biggest things, was like, how do you track this? Not, it was just a simple calendar book and write that stuff down. So if and when that does happen, it's like, hey, here's the book, here's what I did. I also have pictures and videos, and I post almost everything on Instagram. So it's like, hey, you can just go look at it right here. Here's me there.
Yeah.
But it's just one of those simple things that in the moment feels like an extra step, but in the long run makes so much sense. Because one thing that we didn't mention is that if you're married, those losses can transfer over to your spouse's income as well, right? So if you decide, hey, the real estate professional status makes more sense for us as a family, for me to maybe have a part-time job and then do real estate majority of the time to qualify for that, you're now wiping away the rental income, and you can start taking a chunk away of your spouse's income if there's enough losses. So you can play the game, like you said, as hard as you want to, as long as you have all the documentation in place. Is that correct?
Right. And what you said there with the spouse, with the spouse is another huge strategy, right? One person qualifies the real estate professional status, and now you could take the losses, use it against the spouse's income, and that could be quite powerful. I've seen that work quite well in a lot of situations.
It's worked out really good for us. And once you start getting into some of these different tax strategies with the 1031 exchanges, the cost segregations, bonus depreciation, this stuff has a huge impact on your taxes. When you can, do a cost segregation on a property, even our 4-unit property that we did, when we got like $80,000, you're wiping away $80,000 off of your income. We didn't even make $80,000 on the rental income. And then it's going and taking, a third or a quarter or half of your spouse's salary away. All of a sudden you're now getting money back from some of this, which is absolutely insane.
Yeah, no, absolutely. And if just to kind of give the listeners a kind of a little bit of an illustration of how powerful this might be, let's say that $80,000 deduction, right? Let's just say you're at the 24% tax bracket, right? That's going to be $19,200 in tax savings. I mean, that's a nice chunk of change, right?
Exactly. And especially if, you paid that in all year long on your, $80,000 job. Now you're getting your return back for what you put in, all because you bought a piece of real estate and did what you're able to do by bonus depreciating it, doing the cost segregation analysis, all of that other stuff that, we all have the ability to be able to do. So those are just some of the small but big things that people can do. James, what do you got?
Well, I was going to ask Thomas, like, are you pretty familiar with the cost segregation aspect side of things? And, because I think we should talk about that a little bit, because anytime I have a conversation with a real estate investor about taxes, I always come down to, you should consider a cost seg analysis to apply that to your taxable income because, the results are just kind of mind blowing. And I feel like a lot of people, especially new investors, overlook the benefits of the cost seg analysis, perhaps because it seems a little intimidating at first. But, walk us through like ground up, what is a cost seg analysis and how can it really benefit someone's taxes?
Absolutely. So when you buy a rental property, it's typically going to be depreciated over 27 and a half years in the case of residential properties, so single family, multifamily. And in the case of commercial properties like office buildings, retail, things like that, it's 39 years. So land is never depreciated. So whenever you buy a property, you're going to carve out a portion of its value to land value. I'm not going to go through the details on how to do that, but just to kind of give an example, let's say you bought a $500,000 property and 20% of it is considered the land value. So that means the building value is $400,000. Now, if you were to depreciate that over 27 and a half years, you're going to get a depreciation expense of roughly $14,500 per year, give or take, right? Now, with with cost segregation, what it does is it breaks down that building's components into various class lives. Because when you buy a building, it's not just the walls and the structural components. You have things like appliances, carpeting, and other fixtures, right? And you have land improvements, things like fencing, pools, decks, sheds, things of that nature. So depending on the specific property, somewhere between 20 to 30% of that property can be reallocated to that five-year property or that 15-year property. And the way you find out how much of that is allocated is through a cost segregation study. So in a cost segregation study, an engineer typically comes down to your property, does a survey, and then goes and runs their report and comes back to you and says, okay, well, your building's value was $400,000. And of that building value, well, $80,000 of it's attributed to 5 and 15-year property. And now what that means is that you're going to just by its very nature, that 5 and 15-year property is going to be depreciated over 5 or 15 years rather than 27 and a half years. And that's already boosting your depreciation expense, right? Because just to use a straight line, so there's something called double declining balance. I don't want to get too much into the weeds, but double declining, so straight line depreciation just means you take the depreciation, you divide it by the class life. So let's just say that in this example, it's $80,000 was 15-year property. Well, now you're going to get a depreciation expense of $5,333 on that, rather than if it was all 27 and a half year, it would be $2,900, right? So you're already increasing it significantly just by doing the cost segregation study, but it gets even better than that. There's something called bonus depreciation. Bonus depreciation allows you to rapidly accelerate property with a class life of less than 20 years. So in this example, this $80,000 that's eligible for bonus depreciation because it's 5 and 15-year property, you're going to be able to rapidly accelerate that. Right now in 2023, as of this recording, bonus depreciation is at 80%. So that means you'd be able to take 80% of this $80,000, $64,000, and deduct it all in this year. So that can be quite powerful and generate significant losses in many cases. Now, one thing I do want to caveat with bonus depreciation is it is phasing out 20% per year. So in 2024, you're going to be at 60% bonus depreciation. 2025 is going to be at 40. 2026 is going to be at 20. And from roughly 2018 to 2022, it was at 100%. So you used to be able to just take the full amount and just deduct it, but now, like I said, you're at 80% for 2023. So that's kind of the power of cost segregation studies. You're rapidly increasing your depreciation expense, typically in the first year, and generating sizable losses. And if you can qualify as a real estate professional, you can take those losses and use it to offset your other forms of income, and it can be quite powerful.
So, quick clarifying question: when it comes to 2026, is it going to remain at 20% ongoing beyond that, or is it kind of phased out entirely?
Yeah, under current law, it's gone. Like, so in 2027, there's nothing. Now, a lot of tax professionals believe that somehow, some way, the Congress, the House will, come up with a bill that will extend it out. But there's no way, there's no guarantees. There's actually a bill right now, the Made in America Act, I'm pretty sure it's called, that's on the floor of the House. They have to vote and they have to do all the stuff, but it would actually extend 100% bonus depreciation from 2023 all the way through 2026, and there would be no step down. But no one knows for sure if that's going to pass. And even if it does pass, we're still left wondering what happens in 2027. So,
Gotcha. Well, it seems
Exactly.
like there's still enough to really make use of it at this point. But let me ask you a question. This is a personal
Yeah.
question. I'm looking at a piece of land. This piece of land has a billboard on it, in
okay.
addition to a couple homeless people tents. I probably can't depreciate the homeless people's tents, but I'm looking at this billboard on this property. Is that something that might be able to be worked into a cost seg analysis? Because it's otherwise just vacant land. And I'm wondering if it might be worth it for something this small to do a depreciation on.
Yeah, that's a great question. And I'm going to be 100% upfront. I'm not 100% sure off the top of my head, but I'm pretty sure that it's considered land improvements. So it probably fall under that 15-year bucket. And if it falls under that 15-year bucket, then that means it would be eligible for bonus depreciation.
Okay. I'm going to look into that a little further.
Yeah.
There you go.
You could probably ask a cost seg person. They'll be able to tell you right off the bat. And if I had my research in front of me, I'd probably be able to tell you too. But I'm pretty sure it's land improvements.
Yeah. Well, we know a guy, Yona Weiss. If anyone wants to go back in the history of our recordings, check out that episode with him. He dives deep into cost seg analysis. Definitely worth a listen.
Exactly. Well, I was going to ask one follow-up question to this. So let's say we have a listener out there that has a couple properties that they're hearing this and they didn't know about it. And they're like, man, well, I bought this property 2 years ago and I haven't done a cost segment on it. Can I still get my bonus depreciation on my 2023 taxes? What's the answer to that?
Yeah, so it is possible. So, but it gets a little complicated. I'll break it down. So, bonus depreciation, it's technically called first year bonus depreciation. The reason why it's called that is because the first year you placed a property into service or you put it in operation, that's when you're able to claim it. If you don't claim it in that year, then you could still take it, but what you have to do is you have to use a form 3115 and do a 481A adjustment. And that's just some accounting jargon there. But basically, there's a bunch of forms that need to be filed on your later tax return to bring that depreciation that you should have taken in the first year into whatever year that you're bringing it into. So the short answer to that question is yes, you could do it. But it gets more complicated and costly to do, basically.
Well, I asked because I ended up doing that because I was like, I'm like, wait a second. I learned about doing all of this and I'm like, oh man, I bought this building 2 years ago and I didn't do this. Like, will it benefit me now? So that was one of the questions I asked during my quarterly meetings with my tax strategist was like, hey, I had some guy on the podcast. We were talking about this. Can this benefit me? Should I even consider this? And we crunched the numbers and we're like, yeah, it makes sense. So it's just another one of those things where if you're talking to the right people, like you can go back and amend some of the things that you've done. Like, let's say that you're getting ready to sell a piece of, let's say you're getting ready to sell a property this year, and you're about to come onto some huge capital gains and you completely forgot that you bought something a year or two ago. It might make sense for you to go back and do that to offset the gains you're about to make on this rental you're about to sell or something like that. So I'm just asking these to help because I'm sure there's a ton of listeners in different situations that this could definitely help them out, pay less taxes. So it's like there is options out there. It's usually not a no. It's a, hey, we can do this. There's just a lot of steps in play, and a generalist doesn't necessarily know those steps, right?
Right. And that's sometimes the issue. Sometimes they don't even know you could use bonus. Believe it or not, I've had people, CPAs, like in email threads, say that clients can't even use bonus depreciation, which is just not even true. But anyway, yeah. So yeah, you could do it. You could bring it forward. You could definitely bring it forward.
All right. So with the, so we've done the cost seg, we've talked about some other big things. Like let's get into some little things. Like, what about when someone is doing a tenant turnover, or they're doing a tenant improvement on their property, and they're renovating a unit, like what are some of the steps that they can take to be able to provide their CPA documentation on all the expenses to maximize those deductions? Because there's a lot of people out there that might not be able to do a cost seg right now, that might not be able to do some of these more complicated things. That might be like, hey, what are some of the steps that I can do now to prepare myself so at tax time I can hand my guy this, and I can go, hey, I have X, Y, and Z, and here's how it's set up. Help me out.
Right. So yeah, it's a great question. Like, so whenever you're doing a tenant turnover or you're doing improvements to the property, you have to be aware of you have to ask the question, is this capitalized or is it immediately expensed? So for example, most repairs and maintenance will be immediately expensed. And what that means is you just deduct it today on your tax return when you go and file. Capital improvements, however, they're capitalized to the property, they're depreciated over time. Like we've kind of been talking about. So you kind of want to be able to expense it immediately whenever possible. And there's something called the de minimis safe harbor. So the de minimis safe harbor allows you to expense items that are under $2,500 per invoice line item. So this is really a key language here, because if you sometimes, we've seen taxpayers, they'll go and they'll talk to their GC or whatever, and they'll get a renovation complete, and they'll say kitchen rehab, 25 grand. And it's like, okay, great. We really don't know what really went into that kitchen rehab. So we're kind of forced to capitalize and depreciate it, which is spreading out that expense over many years. But if you get an itemized invoice, we might be able to say, okay, well, there's a faucet here, there's some cabinetry here, there's carpeting there, some appliance here. And if it's broken down on the invoice the right way, if it's under $2,500, we can go ahead and just start expensing some of these items rather than having to capitalize it. So I guess the tip or the action item here, would be to whenever you're doing repairs and maintenance, whether you're doing it yourself or you're having a third party do it, you want to have itemized receipts, itemized invoices of the materials and the work that was done, so that your CPA can, A, see what can they expense immediately that year, but also B, categorize it. Because like I was kind of mentioning before, some of these items can be depreciated over shorter periods of time. So you might have some 5-year property or some 15-year property in a renovation that might be eligible for bonus depreciation. But if it's all clumped together in one giant expense, then it's really hard for your CPA to be able to see what that is. So having a good scope of work, having the itemized receipts and invoices can go a long way in maximizing your current expenses and minimizing your taxes in the current year. So that's something I think that anybody can really do. And just one last thing on that, it also comes down to your bookkeeping, right? Your records. And I know I mentioned that before, but it's just that critical that having good books and records properly allows your accountant, allows your tax preparer to really go in and make sure that they're maximizing your deductions when it comes time to file. So those are kind of two things I think anybody could do in those situations.
So, along those lines, I could just imagine your face if a client shows up with a shoebox full of receipts and like your head explodes and you're just like, I don't know, might not be the right client for me. What is that bookkeeping solution that you recommend? Because, I know as part of my business, I just hate the bookkeeping. I do it by myself, for myself, but like, what do you recommend for your clients? Like, do you offer that as a service? Is there another third party service provider that seems pretty easy for idiots like myself to get a hold of that bookkeeping process? Like, what do you tell your clients so that they're prepared?
Yeah. So in an ideal world, you want to have a bookkeeping system, a true bookkeeping system. We recommend QuickBooks Online. It tends to be the most flexible. And it also we've had clients. Okay, let me put it to you this way: you can use QuickBooks Online for one property or 1,000 properties. Like, that's how scalable QuickBooks Online could be. So we typically recommend having a true accounting system like QuickBooks Online. Now, you could set up yourself pretty easily. or you can have an accountant set up for you, or you can take a course on doing that. So we do a lot of accounting setups for our clients where we'll set up the accounting system for them, and then sometimes we'll hand it back over to their team, and either they'll have someone, they'll do it, or they'll have a VA do it. So that's kind of one way to go about it. Another way is you can just hand it off to a bookkeeper to do full time. Now, kind of when we go down kind of the path of bookkeeping, there's kind of a few different ways you can handle it. You could do it yourself. You could have someone on your team do it. You could hire someone to do it. Now, when you're doing it yourself or you're hiring somebody to do it who's going to work for you, you have to oversee them, and you really have to make sure that they know what they're doing, because you might not be the accountant, right? They are. So you need to make sure that you know what they're doing. But usually when you hire somebody, you have a greater degree of flexibility in how things are done, when the timing of when you will receive your financial reports and things like that. However, with that comes, again, the management responsibility, as well as, usually higher overhead costs. Now, another way you could do is you can outsource it to somebody else. Now, like a bookkeeping firm, and we do provide this service, depending on the size of the portfolio. Usually it makes more sense for larger portfolios, but basically when you outsource it, you're giving it over to somebody else, and they're going to give you the financials. But the difference between having an employee and like an outsourced bookkeeping firm is the outsourced bookkeeping firm is going to be more standardized for the most part. There are ways to get more customized services, but if you want control and you want to have a lot of oversight on what's going on, you typically want to hire somebody else to do it. You want to hire somebody on your team to do it. But if you don't mind outsourcing it and just getting your reports on the 15th of the month, for example, and that's when you'll receive them, then you can go with an outsourced outfit. So those are kind of the ways to do it. You could do it yourself, you could have somebody on your team do it, or you can outsource it to somebody else.
I personally use QuickBooks. It's pretty idiot proof. Like after you get it set up properly, pretty easy to work with. Patrick, what do you use? I'm curious.
That is a great question.
He's a shoebox guy. I knew it.
Dude, I am terrible. So I'm in the camp of let's build it and figure it out. And that's what led me to, you guys in the first place, like Hall CPA. And they've recommended QuickBooks. I'm not that guy. Like I want to hire it out, but I'm more focused on like building the revenue, finding the properties, fixing the deals, like all of that. That's my wheelhouse. And the whole like tax thing, I'm all about like the stuff that we've talked about, like maximizing all of that. But when it comes to the daily like receipts and expenses and all of that, that's not my cup of tea. I sit down and do it like the 2 weeks before I have to turn it in, and it is a nightmare. But I'd rather just focus that time on it then than do it throughout the year. So I am really interested in moving forward and passing that off at some point. But I know that with doing that, that still requires me to do something, which I'd be willing to take like the pictures of my receipts and link my credit cards, but it's just kind of one of those things,
Right.
So for the listeners out there, like you've got my end of the spectrum where we have 35 rentals, all these different properties, and I'm doing some of these, complicated tax strategy stuff. And I am like a CPA's worst nightmare. Or you've got some people out there with one property that's listening and is like, hey, do I need to get QuickBooks? Do I need to get this tax strategist? So let's dive into that a little bit. Like, where do you kind of recommend people kind of get their house in order? Should it be from the beginning and that makes it easier? Are you like, hey, don't put the cart before the horse when it starts becoming a problem? Like, kind of give us a little guidance here.
Yeah, this is a really interesting question, and I'm going to kind of teeter between like the entrepreneurial hat and the accountant hat here, because like in some ways I'm completely on board with kind of what you're saying. Like, look, as when you're starting a business, or whether it be rental or otherwise, like you need to dedicate your time, energy, resources to building. And sometimes it's not always the most cost-effective thing to go out and get a tax strategist, get a bookkeeper, get QuickBooks Online when you're just starting out. So kind of having said that, putting back the CPA hat on, it can be easier to do everything when you do it right from the beginning. However, having said that, kind of going in between now, I'd say it probably makes sense to start looking at a tax strategist when you have like 3 or 4 properties. Maybe you're getting up there on the properties. You really want to have someone start looking at your situation, because that's the point when you could start missing out on significant opportunities. So I'd say after you have a few properties under your belt, that's when you want to really start building out like your team of tax strategists, tax preparers, things like that. On the accounting front, on the other side of it, I say you could probably get away with using a spreadsheet or a free solution like Stessa, for the first handful of properties. But then really once you start getting up to like 4 or 5 properties plus, that's when you're really going to want to lean into a more accounting specific solution like QuickBooks. And then when it comes time to actually outsourcing the accounting, that really varies on preference, but you're typically looking at a decent sized portfolio before you're ready to do that, just so you have the economies of scale to kind of spread out those fees across multiple properties, and it's just not hitting all one property when you might need those resources to continue to build. So I know I kind of went a little over the place there. I don't know if that really answers your question.
I mean, I think that's a great answer. And kind of for me specifically, it was all right. Instead of let's build it, let's self-manage it. And the money that we would have been spending on hiring a property manager, we'll now spend on hiring our tax strategist. And now it's getting to the point where I've had enough meetings with them where it's like, all right, we have to get our bookkeeping in order. So now it's like, hey, it's time to start getting our bookkeeping in order. And we're getting there. It's a progress, but I know that's my problem, and I'm sure there's other people out there listening too that are like, hey, I'm in the same boat. Like, I know it's something that I need to do, but you feel like other things are more important. But then when you have these conversations, you realize the importance of them, because like you said, you could be missing out on a lot of opportunities, on a lot of expenses. And I know right now, when you're buying a lot and you're renovating a lot and you're not paying taxes, it really doesn't matter. It's the years when you're not doing all that, that all those systems in place, that proper bookkeeping, that proper tax strategies that you have, those are the years when things matter more. That's just my personal philosophy on that. But it's
Right.
like, hey, get them in place now so you're not behind the curve down the road when you really wish you should have.
Right.
So
Right.
that's kind of where that is.
Well,
James, buddy.
yeah, Patrick, man, if you don't have any more tax questions, I'm interested in talking about Thomas's portfolio of, LP investments, and the passive side of things. Do you have any other tax questions?
I do have one more for the listeners out there. So, let's say we've just went through this last half hour, 40 minutes of all this great tax stuff, and somebody wants to possibly reach out and get a gauge on what having a tax strategist is going to cost them. Can you give the listeners out there kind of like an idea? I know a broad range of kind of what they can expect, to hire a firm like yours for an individual basis.
Right. Right. That's a good question. So typically, for a firm like ours, we're looking at our tax plans start at $5,000, go up to $10,000. So depending on what you want, most of our clients end up falling, in that $5,000 range. But it all depends on what the size of your portfolio, what your preferences are in communication, and all things like that. So that's kind of what it looks like now on tax preparation. It can vary pretty widely depending on the size of your portfolio, your income sources, what strategies you're using, if you're doing cost segregation studies, if you're doing Form 3115s. But you're looking at somewhere probably around $1,500 per tax return or more, depending on their situation. So I'd say I think our average client spends around somewhere between like 7,000 something to like $10,000 a year with us. But most of our clients, if on the advisory side, the tax planning side, are typically recouping their costs and plus some in many cases in anywhere between 1 to 3 years. So, and we tend to look at that, at least our firm, we tend to look at, can we help this person save money to, can we help them get immediate value, or are we just going to be just taking their money? We don't like to do that. So we look at people's situations and really try to take on people where you're going to see a return on your investment within the first year for the most part, if not the next 1 to 2 years, depending on your strategy. So,
and
Just
tax strategy services are definitely one of those things that pays off in the long run. And a lot of people are adverse to doing it because it's going to cost a lot of money up front, but it really yields a lot of return down the road, especially when you get that advice to restructure your business and do things consistently for years and decades. It pays dividends. So
yeah, and I would just add one more thing to that and say it's kind of like legal advice, right? Well, it's a little bit different because in tax advice, we might be able to get you immediate tax savings, but with legal advice, it's more or less if you don't get the advice today, right? You might do something wrong that might come down to bite you in the future and can be a lot more expensive down the line. And we see that a lot of times too, just structuring your business and making sure you're laying the groundwork today so that you can recoup future tax savings. So it kind of works in the short term and the long term. So
yeah, I see that a lot on the legal side of things with people in operating agreements. They'll get into a partnership real quick and just not even pay attention to the rules of the game that they're going to be playing with the partners. And then lo and behold, 5 years down the road, they're like either pissed at their partner or they want to take some money out and there's disagreement. So the legal side of things, tax side of things, you want to be ahead of the ball for sure. Let's talk about some passive investments, Thomas. Like, what do you got going on the LP side of things? I'm kind of curious to hear like your experiences investing the way you have been investing and just get some background.
Right. Right. So right now I'm generally mainly a passive investor. That allows me to focus on the accounting firm full time. We have some business units that we're building out that I'm heavily involved in. So that kind of that just takes up so much of my time. I don't have the mental energy to direct it to real estate today, like active real estate investing today. That will come at some point down the line for me. But the way I do it now is I invest in limited partnership interests, effectively in syndicates and funds, and that allows me to get exposure to real estate into a tax advantaged asset class without me necessarily having to pick up the hammer and do the work or coordinate everything today. So the way I look at passive investing is when you're investing in syndicates and funds is the sponsor is by far the most important piece of that entire puzzle. And that's because the sponsor, the management company, the operator, they're going to be running the deal day to day. And a good sponsor can take a very poor deal, and it's not just a cliche. This is true. I've seen it. You can take a poor situation, turn it into a positive one, but a bad one could take a very good deal that's like a home run deal and turn it into a nightmare very quickly. So when I'm investing passively, there's a few things I'm looking at. I'm looking at the asset class and saying, okay, is this an asset class I want to be in? Does the asset class have potential in the future? Where are we in the cycle for the asset class? And then from there, I'm drilling down into, okay, well, where can I find sponsors, good operators who can operate this asset class effectively, has a track record of doing so, to put myself in the best position of taking the money I give them and multiplying it and not losing it or doing capital calls and doing all types of crazy stuff. So right now I've kind of really interesting story. So a few years ago, I felt the multifamily market was kind of getting overheated, I think in like 2021. And I think a lot of people may have felt that way. So I was like, you know what, I'm going to go find a more conservative sponsor. And I found one that invests that has a fund structure. So we spread the capital across multiple properties. And they also only leveraged up to 65% debt. And they usually were able to get long-term debt or longer term debt. And that's a positive thing. So I went and put my money in with them, and everything is running really well with that specific fund. Now, there's other sponsors out there and other deals that use bridge financing, and they didn't use rate caps. And what happened is now you're seeing this debt that was maybe 3-year debt at a 3% interest rate or 4% interest rate, right? But now interest rates escalated so quickly that it's now like, you're looking at 6 or 7% interest on a really heavy asset, really expensive asset. And they can't afford to refinance because the debt payments would be so high right now that they would be operating at a loss. And what this is causing a lot of people to do is they're going to have to be making capital calls. A capital call is, say you put 50 grand in with a sponsor, and now you would expect that that 50 grand is eventually going to multiply for you. But now if the sponsor is in trouble, they can't afford the debt service, then they're going to call their investors for additional money. And now you have to kind of put additional money into the deal. And depending on how the operating agreement is written with the sponsor, you might end up having to if you don't put the money in, you might end up being in default, right? In some cases where you might actually start having to owe the sponsor money or pay interest on the money that you're not putting in. That's something that can happen. Other cases, you might get diluted, and that's maybe the best case scenario, because you did not put in the money and everybody else did. So capital call is generally not a good thing, and you just got to watch out where we are in the cycle, what type of debt people are using. So I think the moral of the story is just like, for me, I'm looking at the sponsor, what's their experience. I'm looking at where we are in the asset in the cycle, and making decisions based on that. So that's just kind of one little story that I have related
Yeah,
to.
I cannot imagine a worse scenario than getting a capital call, having to fork over money to a syndication that's already kind of ass up on their debt structure.
Right.
Just know that you're going to be handing over money. You might not ever see it again. And if you don't, you might not ever get the money back that you put in. So it's a real catch-22 situation, as to, double down into a failing business or cut your losses, and, literally. So, that's an interesting thing I think we're going to see play out over the next 24 months. Who knows, a lot of things that are up in the air, and for decision to be made by others like Jay Powell and such. But anyways, what asset class was that conservative fund in? I'm curious.
So
What kind of asset that is.
So multifamily, and that specific fund invests primarily in like Class A. So they're investing in quality assets that, and because of the debt structure, it's able to weather the storm that we're seeing now. So it's multifamily.
Gotcha. And earlier on, you mentioned two other assets: car washes and industrial. I'm more interested in the industrial opportunity that you're have explored or are a part of now. But let's touch on those two.
Yeah, so it's a fund, and they invest in specifically single tenant triple net leases that are long-term leases. So you're looking at like 20-25 year leases. So they're locked in on those. And the way that like industrial works, which is really interesting when you're dealing with triple net, is the credit worthiness of the tenant matters a lot, because you're sometimes building out buildings specifically for a specific tenant. And now imagine you build out a building that's fitted for a specific tenant, they stop paying. Well, now all of a sudden you have to go and find another tenant that can maybe use that. And if they can't, then you have to go and renovate that entire property to fit another tenant. That could be a lot of money. So when the tenant has good financials, they're really credit worthy, that they could pay that long-term lease, and it's a very secure investment. Another really interesting thing about triple net leases, not necessarily only industrial, but in general, is that you're not paying the expenses, right? As the owner of the property, many of those expenses are being handed off to the tenant, and they're taking care of those. So what that does for you is that your risk of your inflationary risk is much lower, because your net operating income, right, your income minus expenses, is primarily driven by the revenue. So when these leases, they typically have rent bumps in the leases year to year, and those rent bumps, when they increase, it's going to increase your NOI, but you're not taking the hit on the inflation, right? So on the inflated expenses. So I found that to be a really attractive investment, given the inflationary environment we've been in for the last few years. And at the same time, these long-term leases allow us to also have flexibility on the interest rates, right? Because if interest rates remain high, cap rates might continue to expand, right? And you might end up having to hold the asset longer than expected. and just having these long-term leases kind of gave me a little bit more comfort in that investment in the current environment that we're in. So that's kind of why I ended up going with that. That was also a fund, so it's spreading across multiple investments and spreading the risk around a little bit.
So one thing I'm curious with that particular investment, you look at multifamily syndications, they're buying the property, doing some sort of value add, if not just trying to increase rents. And then, you've got some sort of liquidity event, either a refinance or sale between 3 and 6, 7 years, whatever it might be.
Yep.
And, that's kind of what's advertised as the expected holding term, 3 to years plus.
Right.
What's it look like for this fund? You've got a long 20, 25 year lease in place with a single tenant. Like, are you putting this money in there? Like, and they're telling you, maybe 20 years before you get your money back, your principal.
No, fortunately, it's not that quite that type of deal. So there's kind of two different things that play on the specific deal. So it's a strategy called private equity called a roll up, right? And the way it works is, right. Say I'm a private equity fund or a big hedge fund, right? Like I don't have the resources to go and I may have so much capital, or an insurance fund in some cases. I might have so much capital at play that I don't want to go buy 1 or 2 properties. It's just not work. The work itself is not, it's not worth it to me. However, if you go and aggregate 20 properties, I might buy your entire portfolio of properties. So what this group specifically doing is started a fund and going to go ahead and aggregate all these properties and then flip it ultimately to a private equity fund or hedge fund later down the line at a lower cap rate. And the reason why they'll be able to get the lower cap rate presumably is, well, 2 things. And this is the second part. So the second part is cap rates are kind of higher right now. They're expanding due to interest rates. So you're able to buy it at a lower valuation. So you're able to buy at a cheaper price. And then interest rates are expected to come down in the future and over the next handful of years. And that would compress the cap rates again, pushing up the value. So that's one way that's one exit strategy. Buying today at a higher cap rate, selling later at a lower cap rate. So buying low, selling high. The other part of it's we're rolling it all up, and the person and the end buyer would be willing to pay a lower cap rate on a portfolio of assets than maybe they would on an individual asset. So by rolling up all these assets and accumulating them and packaging it up and selling it to an end buyer, that's kind of the play. And it's expected to be, like a 5 to 7 year play. So it's not this long play, but you have the flexibility on the risk side that, okay, well, if this doesn't play out, cap rates, continue to expand. And in the worst case, we could always hold this asset for a lot longer period of time because we have these long-term leases locked in.
Exactly. And that's something like, we're talking about like Amazon fulfillment centers, FedEx,
right?
UPS, these large industrial assets, like you said, and then you could go and package up 10, 20, 30 of these facilities and flip them to someone like a BlackRock or somebody out there,
right? Exactly.
That needs to put it in a pension fund somewhere or something like that. That's kind of the play, like some large multifamily guys are doing right now and have been doing, acquiring 5,000 units and then flipping it up as well. It's just
right,
different asset class.
Right.
So that's super interesting. Well, I really love talking about the different passive ways to go out there, but again, from what I'm hearing is it's not as passive as you'd think, because you have to do your own research up front with those operators, the types of assets that they're looking at, the types of debt structure that they have, the lease structures inside of them, because as we know, syndication, multifamily syndication went through the roof. You couldn't jump on Instagram or Facebook over the last 2 years without getting slapped in the face with someone's amazing deal that you now hear are falling apart with thousands of units going into foreclosure. So real estate is passive, but not as passive no matter what you're doing. You know what I mean?
Yeah.
You don't have the time and physical time and effort right now, energy, to go in and invest in yourself. So you're passing it off to somebody else, but you're still doing the research up front, right?
Right.
So that's one of the biggest things, like, talking about some of these other ways to invest. It's passive, but you still have to put forth effort. And I like to make that extremely clear for for everyone always, because there's always hard work behind anything that's really rewarding, you know? Right, James?
Right.
Exactly. Thomas, give our listeners like an actionable step for finding a sponsor. Like you're in the field, you're in the space, you know a lot of people, I'm sure you have a lot of connections, but for the average person who's an accredited investor who's trying to find a good sponsor to roll with, I'm not asking you to name names, but just strategically, what would they do first step to go find that sponsor?
Yeah, so that's a tough one because what I would have said maybe a few years ago is a lot different than I would say today, because there's a lot of minds you have to watch out for out there in the field. And well, I would say this. So two ways. I would say you could listen to podcasts. There's a lot of sponsors out there that have podcasts. Then if you're going to do it that way, you really need to do really thorough due diligence, because there's a lot of people out there who are really good at marketing, but may not be so good at operations. So if you're going to go the podcast route, or any type of route where you're finding marketing materials, do your due diligence. Now, as a second way, join communities. There's a few communities out there that basically vet sponsors, and they'll have all their stories, their war stories of what happened, good with sponsors, what sponsors performed, what sponsors didn't. And now that's not a substitute for doing your own due diligence, but it can give you a deal flow, because now you could see sponsors, which you have sponsors you could start doing due diligence on. So that's how you could find them. But also B, you could see what other people are saying. Hey, this really worked well for me. And by the way, avoid these sponsors, like, because they were horrible. So I'd say try to find yourself a group of people who've been investing as a limited partner for a few years now, and you will be able to that'll go a long way in helping not only identify deals, but also kind of helping vet them as well.
Perfect.
Love it. Love it. Well, Thomas, we have talked about so much tax strategies, ways that just the regular guy that's out there with one or two properties can maximize his return. Also, some high level stuff. We've gotten into some limited partner stuff, all kinds of great stuff. And I think this is a perfect transition into our next segment of the show that James and I call the Big Four.
Big Four.
James, take it away, sir.
Yes, sir. All right, Thomas. So I want you to tell our listeners something that you do, maybe on a personal basis. That's like a financial independence hack, something that's a cheat code to really propel your finances forward.
That's a good one. So I'm gonna try to break it down very, very quickly. So it's a strategy. Okay, so it's basically you have what you call a pig, not a pig. You have a primary income generator. That income generator is going to allow you to get the seed capital, for lack of a better way to put it, to go and invest. So that's the stage I'm in right now, in a phase. I'm generating a primary income generator to be able to pour the capital into my investments in the future. And those investments, the limited partnership interest I'm investing in, will help me build my capital even further. And then eventually I'll have a big lump of capital I'll be able to go and buy buildings with. And that will be how I get to financial freedom. So I hope that answers the question.
Work on your pigs. I like it. I think a lot of people get too involved with, trying to invest for the sake of investing. They think they, can buy a couple properties. But I think the missing part, where people who are trying to escape the W-2 is you need income to buy that stuff and to buy the assets. And if you're not, you're just creating another business, to generate more income in a different way. So, it's always good to focus on your skills, to develop yourself, earn as much money as you can to invest, so it can compound for the next couple of decades. So I think that's a great answer.
All right. Thank you.
Love it. Number 2, we call this one resources. So are there any particular books, podcasts, or people that have shaped your financial independence journey, your real estate mindset, that maybe our listeners haven't come across, heard of, that they should go check out?
Yeah, so there's been a lot. It's really it's a lot. So a podcast that really has changed my mindset, really helped me over the years. I was listening to these guys for a long time, Jake and Gino. They are multifamily guys. They really kind of helped shape my mindset on multifamily investing, and that kind of helped me in some of the deals I'm doing now. There's another book. There's a book called The Hands Off Investor by Brian Burke. And if you're going to be investing in passive deals as a syndication, in syndications or funds, that's probably the number one resource. And I would consider that a must read if you're going to be going into that. It kind of breaks down everything you need to know. And I'd say even if you're a sponsor, even if you're sponsoring deals, you should probably read that book too. It's that good. It's been a tremendous resource for me.
Awesome. Awesome. Two, we haven't got that podcast before, and we haven't got this book before. So 2 new ones on that one. James, number 3.
All right, Thomas, it's your future you. I want you to paint a picture of your life, business, personal, 5 years from now. Where are you? Where's your business? Where's your real estate?
Yeah, that's a great question. So okay, 5 years from now, I have a property in New York, I have a property in South Florida, and I snowbird back and forth. I'm probably married with kids, hopefully at that point. And in terms of real estate, in 5 years from now, a lot of these LP deals will probably start to liquidate. And I should have some more capital rolling in. So at that point would be a point where I'm strongly considering moving on to the next phase, which would be buying properties myself and really starting to build that that long-term portfolio that I would hold for forever, pretty much.
Leave it to the tax guy to figure out that you should be snowbirding down in Florida. So I love it. If it suits you perfectly.
Thank you.
It gets cold in the Northeast in the wintertime, man.
Yeah,
it
of
could get
course.
into the teens up here in New York, so wouldn't be bad to be in Florida.
Exactly. All right. And with that, so for anyone out there who feels a little more educated, who feels a little more motivated, who feels a little bit more inspired and wants to reach out and possibly work with you, maybe ask you another question or two, like what's the best way for our listeners to get in touch with you?
Yeah, so there's 2 ways. So if you'd want to work with us, you could go to the realestatecpa.com. There's a big get started button there. You could request an initial consultation with our team, and we'll be able to learn more about your situation and kind of talk through how we'd be able to help. So that's the first way. The second way, we have a Facebook group. So if you just have a question, we have a Facebook group, Tax Smart Investors. And you could check that out by going to facebook.com/group/Tax Smart Investors. Join that group, and members of our team, myself included, are in there on a daily basis answering questions, helping people out. So those are probably the 2 best ways to do it. I'm also over social media, but I'd say those are probably the 2 best ways to get in contact.
Awesome. All right, you guys know the drill. This podcast is free, but not quite. All we ask you to do is leave us a review, send us a DM, do something. Share this podcast with a friend. Share this podcast with family members. Hey, Thanksgiving and Christmas is coming up. What better to talk about around the table than one of the episodes of the Real FI podcast? So share, like, comment, Google, Spotify, Apple. You guys know the drill. Please share this because we guys do this for you each and every week. And with that, we'll catch you next time. Peace.
See you guys.